to each and every trade. In principle, there is nothing wrong with adopting and adhering to a single indicator for decision making. In fact, the discipline involved in maintaining a focus on a single measure is related to the trader's discipline and is perhaps one of the main determinants of achieving success as a trader. But what if your chosen indicator is fundamentally flawed? What if conditions in the market change so that your single screen can no longer account for all the eventual outcomes operating outside of its measurement? The point is, because the market is very complex, even the most advanced indicators can't work all the time and under every market condition. For example, in a market uptrend, trend-following indicators rise and issue buy signals, while oscillators suggest that the market is overbought and give sell signals. In downtrends, trend-following indicators suggest selling short, but oscillators become oversold and issue signals to buy. In a market moving strongly higher or lower, trend-following indicators are ideal, but they are prone to rapid and abrupt changes when markets trade in a range. Within trading ranges, oscillators are the best choice, but when the markets begin to follow a trend, oscillators issue premature signals. This is why Alexander Elder came up with the triple screen system. The triple screen system was proposed by Elder as a stock trading strategy, but it's regularly used in Forex and other markets as well. So what is the triple screen? The triple screen is essentially a trend-following system, but the main characteristic is that it works by analyzing charts at multiple time frames. The root of Elder's triple screen is that it tries to time trade entries to coincide with market corrections or pullbacks. This can happen in both bull trends and bear trends. The strategy only buys or sells when the signals between different screens at different time frames are in agreement. Here are the steps you should follow if you want to implement the triple screen. The first step is to choose which charts to use. Most traders who use the triple screen choose a time ratio of between 3 and 5. This means that the period of each chart reduces by a factor of 3, 4, or 5 from the longest duration chart to the shortest duration chart. If the long range chart is the weekly, we divide by 5 to get the tactical chart, then by 5 again for the executional chart. If the exact period chart doesn't exist on applying this rule, the closest one is used. If you prefer to hold your trades longer, you might use the weekly, daily, and the 4-hour chart. For swing traders, the daily chart, the 4-hour, and the 1-hour charts are best suited. The 4-hour, the 1-hour, and the 15 minutes are perfect if you prefer day trading. Choosing the right chart set depends on your trading goals. If you are a buy and hold or sell and wait trader, then a longer range setup is perhaps going to be the best choice. If you trade intraday, on the other hand, you might prefer short range set of charts. Now, how to read the triple screen? In order to identify the entries, Elder's original system used a combination of MACD and the force index, which are types of momentum oscillators. In practice though, there are a variety of other indicators that will do the same job and work equally well or better. I personally use the Hull moving average on the longer term chart, the RSI on the intermediate chart, and I use price action on the short term chart to pinpoint the entry. Timing is everything with most strategies, and this one is no exception. Triple screen doesn't have a definitive buy or sell signal. It works as a system of confirmations from one time frame to the next. This is done in order to find a suitable time to enter a trend in the likely direction the market is moving. This can be both a good thing and a bad thing, because while there are no rigid criteria, this does mean you can incorporate your own thinking into the strategy. It also means you can make it simpler by using fewer indicators. So when to enter the market? The time to buy in a triple screen is when a bull trend has just undergone a correction and is beginning to turn up again. Conversely, the time to sell in the triple screen is when a bear trend has just undergone a correction and is beginning to turn down again. Here's how it works. To identify this, first pull up the longest range screen. In this example, we'll use the daily chart. First step, determine the trend. I use the 100 period Hall moving average to confirm the trend. In this particular chart, we see the general direction of the trend is bearish. Keep in mind that you can use any other tool to determine the trend. Elder used the MACD. I use the 100 Hall MA. You can use your favorite trend indicator. Next, we need to check the middle chart, and in this example is the 4-hour chart. We use this time frame to determine the market momentum. Using the RSI, I look at the chart to confirm if a correction is completing. What we are trying to determine here is that the upward buying pressure from the correction is reducing. This means the flow of profit-taking and other buy orders has hit a peak. It's essential here as well that we check to confirm that isn't the start of a new bull market. If the upward correction is particularly strong, we need to wait. So we need to know that the daily trend is down, and we also identify an upward correction on the 4-hour chart. I'm also interested in the RSI value. I want it to be below 50 and stay below it. Now we add the execution chart, the 1-hour chart. On this time frame, we're looking for the optimum time to execute a sell order. This means we look for evidence that the pullback is completing and the market is reaching an overbought point on this time scale. I prefer to use simple price action. Most of the times I search for a trend line breakout. In this case, we see this upslope trend line, which was broken to the downside after a correction in the direction of the primary trend on the daily chart. When to exit a trade? Normally, there isn't any take profit defined for each order. I prefer to use a trailing stop loss. For this sell order, the exit stop loss is gradually moved downwards as the market makes lower lows. This is done to lock in the profit. The loss amount and the order sizes are set according to your desired risk limits. Let's take another example. The first screen. We analyze this time frame to identify the direction of the larger trend with a trend indicator. Again, I use the 100 Hall moving average. Once the first screen identifies the direction of the tide, this is the only direction in which you will be allowed to trade when looking at your intermediate chart. So if your trend indicator signals that it's an uptrend, like in this example, you can only buy. Second screen. Once we know the direction of the trend, we are looking for a wave in the contrary direction of our intermediate chart that will give us a beneficial entry. So you are looking at the 4-hour chart as your intermediate time frame, as the daily chart showed that the larger trend is upward. You are now looking for a 4-hour decline, which would provide you with an advantageous opportunity to buy the market. You do this by searching for a buy signal from your oscillator. In this example, I use the RSI. I want to see the RSI above 50 and stay above 50. Any sell signals in this case would be ignored because the upward trend from the first screen has already filtered those out. We move to the third screen once we have an agreement from the first and the second screen. That is, when the larger trend is up and an intermediate decline has generated a buy signal from our oscillator. In the third screen, we determine the specific entry point. Like in the previous example, I prefer to rely on price action to enter the market, as I don't like to use many indicators. Here we have a nice trend line breakout on the 1-hour chart, which gave us the green light to enter long. Here are other examples of triple screen trades.